welcome to our channel where we help your real estate investments work harder for you. I'm Samantha from Elevate Realty in Toronto. You probably know it's important to diversify your portfolios, and there are many models out there that recommend how you should split your investments based on your risk level. A good guideline is to change your strategy based on your stage in life because that's when things really change. Now, I haven't been able to find one that truly is relevant for the real estate investor, so I ended up creating one. In this video, I'll talk about a couple of existing models I like and then combine them to show you how a more complete investment strategy might look like. Before I dive in, remember to subscribe and hit the notification bell so you don't miss other real estate investing videos like this from our Elevate team. There's two investment models out there that I think have good bones. The first one is from Investopedia. The basic concept is this: stocks are higher risk, so they have higher but more unpredictable returns. Bonds, on the other hand, are lower risk, so this means they generate lower but more stable returns. Investopedia explains that your investment style will vary based on your stage in life and gives you a guideline for stock and bond splits based on your age. When you're young, your biggest advantage is time, so you can focus on stocks because you have the time to recover from losses. As you're older, you have more responsibilities like a growing family and more monthly expenses. So this means you'll want to reduce your risk level and have a more balanced portfolio between stocks and bonds. On retirement, your objective really is to use your investments as a stable income source. So they recommend focusing on investing in bonds that can give you stable monthly cash flows. The calculations are pretty simple. The percentage in bonds is approximately equivalent to your age minus 10. So if you're 30, you'll want to invest around 20% in bonds and 80% in stocks. But this model really only covers stocks and bonds. So how does real estate really fit into the picture? Here's another model called the Rule of 90 that Canadian author and investment advisor Garth Turner came up with. His model gives you a ballpark of how much real estate should be in your total portfolio based on your age. Turner understands that real estate will be a big part of your portfolio when you're young because you don't have as much money saved up and real estate is expensive. As you get older, you'll want more liquid assets and diversification to reduce your investment risk concentration, so your real estate percentage should also decrease. To get how much equity you should put into real estate, deduct your age from 90. For example, if you're 30, you'll want to put 60% in real estate and 40% in something else. But two questions come to mind. Number one, how much stocks and bonds should I allocate in something else? And two, if we're only looking at the equity portion of real estate, should leverage change based on age? So based on Investopedia's model, we know it's a good idea to reduce your risk appetite as you age. So I think you should also reduce your leverage, which makes investments more risky as you age. And here's a simple chart to illustrate that point. And now that we have some good models as a basis, here's a new hybrid model that takes into account real estate, leverage, stocks, and bonds. The basis of this hybrid model is that you should split your portfolio into higher risk and lower risk investments. As you get older, higher risk investments will decrease and lower risk investments will increase. Now, I did a previous video that showed that real estate without leverage is similar to, say, investing in low risk investments like bonds, and real estate with leverage is more like stocks. So in the higher risk portion, you can either invest in stocks or real estate with leverage. And in the lower risk portion, it can either be bonds or real estate without leverage. And now we're ready to put all the pieces together. When you're younger, real estate can be fully leveraged. This means the higher risk portion will mostly consist of real estate and the rest will be stocks. The lower risk portion are only bonds because real estate is completely leveraged. So for example, in your 20s, you can consider 10% in bonds, 70% in real estate with leverage, and 20% in stocks. As you get older and gain more assets, you'll be paying down your mortgage, which reduces your leverage, so real estate investments also become lower risk. At the same time, we're looking to diversify our assets more, so stocks and bonds will become a bigger part of your portfolio. My personal goal is to be debt-free at retirement. So in this model, you can see that there's no more leverage and real estate has moved completely into the lower risk section of our portfolio. At this point, we'll also want to increase liquidity and have a well-balanced portfolio of stocks, bonds, and real estate. For example, at age 60, you'll want to consider 50% in bonds, 30% in real estate without leverage, and 20% in stocks. By the time we retire, we're looking for cash flows to give us stable income, and that's why Investopedia has a big allocation to bonds. I think Garth Turner's rule of 90 is more for end-user homes, and the good thing about investment properties is that by the time your mortgage is fully paid off, it provides attractive cash flows that's similar to bonds. At this point, you can view your property's appreciation as the cherry on top, and the total returns for real estate with no leverage is actually a lot better than bonds. If you're looking to lower your real estate investment risk, it's important to choose cash flowing properties and focus on locations with stable appreciation like Toronto. Our team specializes in cash flowing investment properties in Toronto, and we can help you find the best ones on the market. You can contact us with a link I'll put in the description below. Finally, if you find this video useful, please give us a thumbs up and help us out by sharing it on your social media and tag us at Elevate Realty CA. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video.